What is happening, traders? Thank you for tuning in. It is Monday, May 17th, and we're back with another episode of Market Cap on Let's Talk Trades. My name is Jason, and today we're going to be talking about carbon pricing and the impact I believe it is having on the broader crypto market. It's definitely the best pod yet, so let's get right into it. Now, global warming is the existential challenge of our lifetime. It's threatening our lives, our livelihood, and the future of the planet. Wildfires, extreme storms, and other impacts of global warming are already causing devastation around the world. And those impacts will only become more dramatic over time unless we move to cut greenhouse gas emissions immediately. Now, to prevent the worst impacts of global warming, the United States must achieve carbon neutrality by 2050. And the Intergovernmental Panel on Climate Change, or the IPCC, warns that world carbon emissions must reach net zero around 2050 in order to limit global warming beyond the level which catastrophic climate change would occur. So, US policymakers must use every practical policy tool to make this zero carbon transformation a reality, such as promoting rapid deployment of renewable energy sources, investing in research and development of clean energy technologies and energy efficiencies, and also taking regulatory actions to push companies away from using dirty fossil fuel. A central element in this strategy should be putting a price on carbon pollution, otherwise known as carbon pricing. This would push companies to cut emissions and switch to clean energy. Pricing carbon pollutions makes companies pay for the damage they cause, and it also incentivizes them to use more energy efficiently and shift from oil, coal, and natural gases to cleaner renewable energies. Now, carbon pricing is already recognized as a valuable tool around the world, and as of May 2020, 46 countries and 32 subnational jurisdictions had already implemented or scheduled 61 pricing initiatives, which covers 22% of annual global greenhouse gas emissions. Cap and trade programs and carbon taxes can both be effective tools to put a price on carbon pollution, but they're very different between the two strategies. Cap and trade, sometimes called Cap and Invest or Cap and Dividend, is a program which sets a cap on the level of carbon or other greenhouse gas emissions allowed by a company. Emission allowances are auctioned or given away to companies, with the total number of allowance issued adding up to a total cap. And companies that are able to cut emissions cheaply can sell the excess allowances they have to companies that have higher reduction costs, or they could just purchase fewer of them at the auction, creating a market price for emissions. Now, caps are supposed to continuously drop over time to keep greenhouse gas emissions falling, and as of 2020, there were 31 cap and trade programs implemented or planned worldwide, and 11 of them were in the United States. A carbon tax, on the other hand, sets a price directly on emissions. Taxing emissions sends a price signal to companies to shift to lower emission alternatives, and it tells consumers to purchase products with lower carbon inputs. Individual decisions by firms and households will ultimately determine how much emissions fall, unless tax levels are set to target specific emission reductions. At the moment, there are 30 carbon tax programs operating or planned around the world today. None at the state level in the United States, though. Putting a direct price on emissions rather than creating a complex web of regulations and standards is likely to be the most efficient way to reduce the net amount of CO2 discharged into the atmosphere. In March of 2021, President Biden raised the social cost of carbon to about $51 per ton. The move dramatically raises the value of carbon, which had fallen to as little as $1 under President Trump. The figure used by Biden mirrors estimates from the Obama era, when it was $50 a ton. and it only stands to go higher in January of 2022 after the administration completes a comprehensive overhaul of Carbon's value. Enter Elon Musk, Jack Dorsey, Tesla, Square, and Bitcoin. So the Tesla boss, Elon Musk, suddenly made a U-turn over accepting Bitcoin to buy his electric vehicles, and it's thrust the cryptocurrency's energy usage into the spotlight. Some Tesla investors, along with environmentalists, have been increasingly critical about the way Bitcoin is mined, and it uses vast amounts of electricity generated by fossil fuels. Musk said last week he backed those concerns, especially the use of coal, which was one of the worst emissions of any fuel. So how dirty is Bitcoin? At current rates, Bitcoin mining devours the same amount of energy annually used by the Netherlands in 2019. And with the world's biggest cryptocurrency, which was once a fringe asset, becoming even more increasingly popular, it is now being accepted by major US companies and financial firms. With this major influx of demand just means higher prices, which is going to lead to more miners. And with more miners competing to solve puzzles in the fastest time to win a coin, Bitcoin is created when high-powered computers compete against other machines to solve complex mathematical puzzles, and it's an energy-intensive process. It relies on fossil fuels, particularly coal, and that's just the dirtiest one of them all. There are growing attempts in the cryptocurrency industry to mitigate the environmental harm of mining, and the entrance of big corporations like Tesla, MicroStrategy, and Square in the crypto market could boost incentives to produce green Bitcoins using renewable energy. There are projects all across the world that are striving for ways to wean Bitcoin mining away from fossil fuels. But this recent pullback in the market, I believe, is caused by the rising price of carbon. Elon Musk backtracked in his stance on Tesla accepting Bitcoin, and Square also publicly said they would no longer be buying Bitcoin at the moment. Check this out, traders. Chinese miners account for 70% of the production of greenhouse gases of Bitcoin. Now, the dominance of Chinese miners and their lack of motivation to swap cheap fossil fuels for more expensive renewables means there's no quick fix for this Bitcoin emissions problem. While not all cryptocurrencies release as much emissions as Bitcoin, Bitcoin is the face of cryptocurrency at the moment. If it tanks, the general crypto market tends to go with it. And with an increased pressure to be carbon neutral, it kind of makes sense why companies had to step away from Bitcoin, possibly focus on cleaner alternative cryptocurrencies. As always, the markets are unpredictable, and Elon Musk seems to have more control than ever. One tweet sent Bitcoin, Doge, and Ethereum in a downward spiral, and it hasn't stopped yet. But there's no denying carbon pricing will get more expensive as we push to save the planet. Carbon capture ETFs are going to be hot in the coming months and years. I would start to look into those as some of the market begins to cool off of this cryptocurrency hype. It's been a pleasure, traders. Thank you for tuning in. Don't forget, do your research and stay green, traders. Peace.